Thank you for tuning in to LeadDeveloper.com, where we simplify complex property development feasibilities, investment analysis, and everything real estate. Whether you're a seasoned pro or just starting out, our Google Sheets-based feasibility suite streamlines the toughest aspects of real estate. Lead Developer Feasibility Suite is trusted by thousands in over 17 countries. Our tools cover everything from quick assessments to detailed cash flow projections and more. Sign up today at LeadDeveloper.com for unlimited free access to our expanding library of real estate tools. No credit card needed. Plus, get full support through Edge with step-by-step guidance, exclusive courses, and resources designed for your success. Turn numbers into narratives that win over investors and lenders. Join Lead Developer now.
All right, so today we're gonna do a deep dive on cap rate.
Okay.
And I think this is something that a lot of people hear, kind of thrown around.
Absolutely.
And maybe don't fully understand.
Right.
And to help me with this deep dive, we have a real estate expert here.
Happy to be here.
I'm really excited to get into this.
Yeah.
We're using an article just titled, "What is cap rate?"
Straightforward.
Yeah, so we're going straight to the source
Right.
with this one.
Yeah.
What I think is really interesting about cap rate is that I feel like it can be kind of counterintuitive.
Yes, definitely.
So we're going to get into all that. So
Yeah.
we're going to talk about, like, what is it,
Yeah.
how to calculate it, what impacts it.
Absolutely.
And the surprising thing that I think some people don't realize
Yes.
is that sometimes a lower cap rate is actually a good thing.
That's right. It's all about risk tolerance and what your goals are as an investor.
Exactly.
And it's kind of a simple ratio, but it can be very powerful.
Yeah, this article defines cap rate as the rate of return on a property investment.
Yeah.
Okay, that seems pretty straightforward.
It is on the surface.
Yeah, and it says you calculate it by dividing the net operating income
NOI.
by the property's market value.
Right.
But what I don't really understand yet is why this single ratio is considered so important.
Well, think about it this way. It helps investors quickly compare different properties and assess their potential profitability.
Oh, okay.
So regardless of their size or price, you can kind of compare apples to oranges using this ratio.
Oh, okay. So it's like a shorthand way
It's a shortcut.
to assess how well a property generates income.
Exactly.
Right.
Yeah.
So that makes sense.
So a higher cap rate basically means the property is generating more relative to its value.
That's exactly right.
Okay.
Yeah. So if you imagine you're comparing two apartment buildings,
Okay.
one is a brand new luxury high-rise in a prime downtown location with a cap rate of 4%. Okay.
The other is a 20-year-old garden-style apartment complex in a suburb with a cap rate of 8%.
So just on the surface, it sounds like that 8% is a much better deal.
Right. You're getting a higher rate of return
Yeah.
on your investment, but that's where the counterintuitive nature of cap rates comes in.
Okay, so then why is that lower cap rate sometimes better?
Sometimes a lower cap rate indicates a lower risk investment.
Okay.
Investors are willing to accept a slightly lower initial return
Okay.
for properties in prime locations
Uh-huh.
with stable long-term tenants
Okay.
and predictable income streams.
Makes sense.
They see these as safer bets.
Okay.
Yeah, less risk of vacancy or fluctuations in income.
Yeah. So it's like if you were to compare it to, like,
Uh-huh.
I don't know, like a blue chip stock that's going to give you like steady dividends
Exactly.
versus maybe like a high growth tech startup where
Yeah.
who knows?
Yeah, much more volatile earnings.
Right. Totally.
Yeah,
That's a good analogy.
yeah, investors with a lower risk tolerance.
Yeah. Might gravitate towards the blue chip stock.
Yeah,
While those seeking high growth potential might be more comfortable with the tech startup.
okay,
Same logic applies to real estate.
that makes sense.
Yeah,
Okay, so this article says this calculation can be used in a bunch of ways.
absolutely. Yeah.
You can use it to see if a seller's asking price is even reasonable,
Yes.
or to figure out like what the fair market value is, or like what kind of net operating income you can expect
Right.
based on like the asking price and what cap rates are in the area.
That's right. So let's say you're looking at a retail property listed for $500,000.
Okay.
And the average cap rate for similar properties in the area is 7%.
Okay.
By dividing the property value by the cap rate, you can estimate that the property should generate around $35,000 in net operating income per year.
Oh, okay.
Yeah.
So if the seller is like, oh, this is going to generate way more than that.
Yeah. That might be a red flag
Yeah.
to investigate further.
Okay, interesting. Or conversely, if the property's actual NOI is significantly lower than that, it might be an opportunity to negotiate a lower purchase price.
Oh, that's a good point.
Yeah,
Okay, so you said it's not just this simple ratio.
it's not.
It really gives you a lot of insight into the property.
It's a powerful tool
Yeah.
to assess, the income potential of the property
Yeah.
and help you make, more informed investment decisions.
Okay, so now I'm curious about this term reversionary cap rate.
Okay, yeah.
What is that all about?
So that's a concept used to value properties that have the potential for increased income in the future.
Okay.
So it's based on the idea that a property's value could be significantly higher once it's fully leased,
Uh-huh.
renovated, or otherwise optimized
Okay.
to maximize its income potential.
So like you're saying it's like factoring in potential upside
Yes, exactly.
of a property
Yeah.
that might not be fully realized yet.
Exactly. Yeah. So imagine a retail center with a few vacant storefronts. The current cap rate might be lower because of the vacancies.
Yeah, that makes sense.
But if you believe those vacancies can be filled with quality tenants, the property's income and therefore its value could increase significantly.
Okay, so this reversionary cap rate is like a way for investors to sort of like look into the future.
It is.
Say like, okay,
It's their crystal ball.
what could this potentially be worth?
That's right. Yeah. It allows them to look beyond the present and assess the potential for future growth and appreciation.
Okay, this is starting to make a lot of sense to me.
Good. I'm glad.
So it's really valuable, like especially for investors who are looking for, maybe properties that need a little bit of work.
Yeah. Value add opportunity.
Yeah, where they can kind of go in and improve things
Exactly.
and then increase that NOI.
Yeah. Unlock that hidden value in a property.
Yeah, okay, cool.
Yeah.
So the article also talks about all these different factors
Yeah. There's a lot.
that impact cap rates.
Absolutely.
It's like interest rates,
Yeah.
the overall economy,
Yeah.
property type
Yeah.
location,
Big one.
the condition of the property.
Of course.
Even the seller's motivation can play a role.
That's right. Because that can affect pricing.
Yeah.
Right. So all of these things can significantly influence the perceived risk and return of an investment property.
Okay.
Yeah. So for instance, in a booming economy with low interest rates,
Mm-hmm.
investors are often more willing to accept lower cap rates because they perceive less risk.
Okay, so like when the market is hot
Exactly.
and there's a lot of competition.
Yeah. You're going to see lower cap rates.
Okay.
Yeah. Because people are willing to pay more
Yeah.
for those properties.
Okay.
Conversely, in a weaker economy with higher interest rates,
Uh-huh.
investors might demand higher cap rates to compensate for the increased risk.
That makes sense.
Yeah, and the higher borrowing costs.
So cap rates are not like a static thing.
They
Yeah.
fluctuate
Yeah, they move around.
all the time based on the market.
Based on what's going on in the economy.
Yeah, a lot of economic and market factors that come into play.
Yeah, and it just seems like it's so important to really understand all these different things.
Absolutely. You have to be aware of what's going on in the market
Yeah.
and stay informed and, adapt your investment strategy accordingly.
Yeah. Okay.
Yeah.
Now, location obviously plays a big role in this.
Huge.
I imagine in determining those cap rates.
Location. That's
Yeah.
a saying, right?
Yeah.
Yeah, it's one of the most important factors in real estate.
Okay.
And it directly impacts cap rates.
So give me an example.
Sure. So think about two identical office buildings.
Okay.
One is in a bustling downtown area with high foot traffic and strong tenant demand.
Uh-huh.
And the other is in a suburban office park with much less activity.
So I would imagine that downtown building would have a lower cap rate.
Exactly.
Since
It's more desirable.
Yeah.
Yeah, investors are willing to pay a premium
Yeah.
for properties in desirable locations.
Because they know they're going to be able to charge higher rents.
Exactly.
Yeah.
Yeah, they recognize that these properties offer long-term value appreciation potential
Mm-hmm.
and lower risk of vacancy.
Okay. So it's really like
Yeah,
weighing these trade-offs, right?
absolutely. Yeah.
Yeah.
Higher initial yield versus lower risk
Yeah.
and potential for future appreciation.
Okay. So this is all making a lot more sense now.
Good.
I'm starting to see that cap rate is not just a number.
It's not.
It really reflects
Yeah.
the entire property and like its desirability.
Yeah, it's a risk profile.
Yeah. All that's
Potential for future growth.
Yeah.
It's a holistic metric that captures the essence of a property's investment potential.
Okay. I love that.
Yeah.
So now I'm kind of curious to get into like
Yeah, let's do it.
some real world examples
Let's crack it.
and to see like how investors are actually using this
Yeah,
to make decisions.
absolutely. I think that'll really solidify your understanding.
Yeah.
Yeah, and highlight, some of the nuances of using cap rate effectively.
So let's say I'm an investor
Right.
and I'm looking at a multifamily property
Right.
in a growing neighborhood.
Huh.
And the seller is asking for a price that's based on a 6% cap rate,
Okay.
which seems kind of in line with like what's average for the area.
Yeah, sounds reasonable.
But I'm thinking about the potential to go in and maybe renovate some units,
Okay.
raise rents a bit.
So you're looking at a value add opportunity.
Yeah,
Okay.
like improve the property.
All right. How would you use the cap rate to assess that?
So I guess like if I go in and I do all these renovations
Mhm.
and I'm able to increase the NOI,
Yeah.
then I can maybe justify a lower cap rate
Okay.
when I eventually go to sell it.
That's right. So maybe instead of the 6% cap rate, you could get a 5% cap rate.
Yeah,
Yeah.
when I sell it.
Because you've increased the property's income, you've essentially made it more desirable
Okay.
to potential buyers,
Uh-huh.
allowing you to command a lower cap rate and potentially a higher sale price.
So that's where that reversionary cap rate comes in.
Exactly.
Yeah,
Yeah.
because I'm looking ahead to what I think that NOI is going to be.
Exactly. And what that future value could be.
Yeah.
Right? And by working backwards from that potential future value, you can determine how much you're willing to pay for the property today.
This is really cool.
Right.
I'm really starting to get it now. It's like, it's not just about like looking at what the cap rate is now.
No, it's not static.
Yeah, but it's like understanding, okay, what's the potential to change that cap rate
Yes, exactly.
by doing all these things?
You got it.
Ah,
Okay, so that's awesome.
that's what savvy investors do. They use cap rate as a tool to identify opportunities to
Yeah.
unlock that hidden value and maximize their returns.
Now, I'm also kind of curious about how this plays into negotiations.
Oh, yeah, sure.
Can you give me like an example?
Yeah, absolutely.
yeah.
So let's say you're looking at a retail property with a current cap rate of 7%.
However, you've noticed some deferred maintenance issues that the seller hasn't addressed.
Mm-hmm.
These issues could potentially lead to higher operating expenses and lower net operating income in the future.
Yeah.
Yeah,
So I could use that to be like, hey, I want a lower cap rate
exactly.
because of this.
You could use that to justify a lower offer.
Yeah.
Yeah, reflecting the potential for higher expenses and lower income.
Yeah.
So maybe say, hey, I want an 8% cap rate.
Yeah, because I'm taking on this risk.
Exactly. You're factoring in the risk
Yeah.
associated with those deferred maintenance issues and demanding a higher potential return
Yeah.
to compensate for that risk.
This is really making sense to me now.
Good. I'm glad.
It's like cap rate is more than just this number. It's like a
Yeah.
language that investors can use.
That's a way to communicate
Yeah.
their risk assessments,
Yeah.
their investment strategies.
Yeah.
Yeah, their negotiation positions.
I like that.
Yeah, it's a common ground for buyers and sellers to evaluate a property's financial performance and potential.
Okay, awesome.
Yeah.
So this has been super helpful so far.
Good. I'm glad we're making progress.
I'm really starting to understand this,
Awesome.
but I still feel like there's a lot more to uncover.
There is.
Yeah.
Yeah, we've just scratched the surface.
Yeah.
But that's a great foundation
Yeah.
for, diving deeper into this topic.
Yeah. And I think in part 2, we're going to get into like, Yeah.
We're going to talk about going in and going out cap rates.
yes.
We're going to look the impact of interest rates.
Yeah.
Yeah, and how all of these things kind of work together.
Yeah. I
Yeah.
think that'll be really helpful.
Absolutely, yeah.
So stay tuned for part 2 of this deep dive on cap rate.
It's going to be good.
We'll be right back after a quick break.
Sounds good.
So I'm starting to see how like really mastering this concept of cap rate can give investors like a real edge.
Oh, absolutely.
Absolutely.
Yeah.
In the market.
Yeah, it's not just about, understanding the numbers, but it's about being able to interpret them
Yeah.
in the context of a specific property
Right.
and the overall market conditions.
Yeah. Okay, so the article also touches on this concept of like going in cap rate and going out cap
Sure.
rate. Can you kind of break down the difference between those two?
Yeah, so the going in cap rate is the cap rate at the time you purchase the property.
Okay.
So it reflects the current market conditions and the property's expected income stream.
So it's kind of like a snapshot
It is a snapshot
of like what's happening right now.
of that moment in time.
Yeah.
Yeah, exactly.
And then the going out cap rate is like what you anticipate.
It
for
is your
others.
anticipated cap rate when you sell the property.
Okay.
Yeah. So it's based on your projections of, future market conditions,
hmm
potential income growth,
Okay.
and the property's anticipated appreciation.
So you're kind of like looking ahead.
You are.
Like sort of there.
You're looking into the future.
What could this be worth?
Exactly. Yeah. And the difference between the going in cap rate and the going out cap rate can be pretty significant,
Yeah.
especially for long-term investment. So if you anticipate the market is going to improve
Yeah.
and the property is going to appreciate in value, you might project a lower going out cap rate
Okay.
than your going in cap rate,
Okay.
indicating a potential profit
Interesting.
from the sale.
Okay, so it's not just about the current income, but also
Well,
about
yeah.
what that might be in the future.
It's the potential.
Yeah.
Yeah, exactly.
So it's important to consider both when you're evaluating a property.
Absolutely.
Yeah.
Especially if you're planning to hold it for an extended period.
Okay, that makes a lot of sense.
Yeah, because you're factoring in
Yeah.
the potential for future growth and appreciation.
Okay, cool. So now I want to get into like the relationship between cap rates and interest rates.
Okay. Yeah.
Because the article mentioned that they kind of like
They do. They're connected.
go together, but I'm not really clear on how that works.
Yeah, so it's a dynamic interplay for sure
Okay.
that can significantly impact real estate investment decisions.
Okay.
So when interest rates are low, borrowing money becomes cheaper,
Mm-hmm.
which makes real estate investments more attractive.
Okay.
This can increase demand for properties,
Uh-huh.
which can drive up prices, which in turn can lead to lower cap rates.
So basically they're like inversely related.
Generally, yes.
Okay.
Lower interest rates tend to push cap rates lower.
Okay.
Higher interest rates can lead to higher cap rates.
Okay, but I imagine it's not always that straightforward.
It's not always a straightforward correlation
Yeah.
because there are a lot of other market factors that can influence cap rates.
Right, like we were just talking about, like the type of property.
Exactly. Location,
Exactly.
condition, the overall economy, all these things.
Yeah, so it's really important to look at all of that.
You have to consider the broader market context.
So how can investors kind of like navigate all of that?
Well, one strategy is to stay informed about interest rate trends
Uh-huh.
and anticipate potential impacts on the real estate market.
Okay.
So if interest rates are expected to rise, it might be wise to focus on properties with strong income streams and potential for future appreciation.
To kind of offset that.
Exactly.
Yeah.
To help offset the impact of higher borrowing costs.
So you want something that's like really stable.
Exactly. You want something that's going to perform well,
Yeah.
even in a rising interest rate environment.
Okay.
On the other hand, if interest rates are expected to fall,
Okay.
investors might be more willing to accept lower cap rates.
Because they can get a better interest rate on their loan?
Exactly, because they can secure more favorable financing terms.
So it's all about just kind of like adapting your strategy
It is.
based on what interest rates are doing.
That's right, yeah. Stay informed.
Okay.
Talk to your financial advisors.
Yeah.
Get their insights
Yeah.
about interest rate forecasts and how that might impact the real estate market.
Yeah. Okay, that's really helpful.
Good.
Now, we've talked about this a little bit, but I just want to kind of like really hit home this relationship
Yeah.
between cap rate and risk.
Yeah, it's a fundamental trade-off.
Yeah.
Any investment between risk and return in real estate is no exception.
So like those higher cap rates are generally going to come with more risk.
They typically do
Okay.
because properties with higher cap rates often involve more uncertainty or potential for volatility
Uh-huh.
in their income streams. So investors demand a higher potential return to compensate for that risk.
Okay, so it's kind of like they need to be incentivized
Exactly.
to take on that risk.
Right.
Okay.
On the other hand, properties with lower cap rates
Uh-huh.
tend to be in more desirable locations.
Yeah.
They have stable long-term leases.
Yeah.
And require less capital investment.
So they're more like predictable.
They offer a more predictable income stream.
Yeah.
And lower perceived risk.
Hmm.
So investors are willing to accept a lower rate of return.
Because they're not taking on as much risk.
Exactly. They're getting that peace of mind
Yeah.
that comes with those types of properties.
Okay, this is all making a lot of sense.
Good.
So it's not just about chasing the highest cap rate.
No, it's not. It's about finding that right balance
Yeah.
between risk and reward based on your investment goals.
I think a lot of new investors probably make that mistake
I think so too.
of just thinking, oh, I need the highest cap rate possible.
Right, the higher the better.
Yeah.
But that's not always the case.
Right.
You have to consider those other factors too.
So lower doesn't always mean better.
No, not necessarily.
Okay.
While a lower cap rate can indicate lower risk and potentially more stable income streams,
Uh-huh.
it doesn't guarantee superior returns.
Okay.
So you really have to look at the whole picture.
Yeah.
You have to consider the property's condition,
Uh-huh.
the lease terms, the potential for future appreciation, the overall market dynamics.
So it's not just about that one number.
It's not.
Okay.
You have to analyze the specific characteristics of each property and its market context.
Yeah. So you need to know, like, what's a good cap rate
Yeah, what's appropriate?
for this type of property in this
Yeah.
area?
Right, exactly.
Yeah. Okay. So if an investor's trying to figure that out, like, where do they even start?
Well, the first step is to gather data on recent sales
Okay.
of comparable properties in the area.
Okay.
So look for properties that are similar in size, type, location, condition
Okay.
to the one you're considering.
So you're trying to find like apples to apples.
Exactly. And once you have that data, you can calculate their cap rates by dividing their net operating incomes by their sale prices.
Oh, okay. So you're basically like reverse engineering it
Exactly.
from like
You're working backwards.
yeah, from what actually happened.
Exactly.
Okay.
You're looking at actual market transactions
Yeah. Okay.
to see what those cap rates were.
Okay.
And by analyzing the cap rates of those comparable properties, you can start to get a sense of, what's typical
Okay.
for that area.
So I'm guessing, though, it's not just as simple as like looking at those numbers.
It's not. You also have to consider those other factors.
Right.
Things like the property's condition, the lease terms, vacancy rates, overall market trends.
So you have to use your judgment a little bit.
You do. It's a bit of an art as well as a science.
Yeah, that makes sense.
And that's why it's often helpful to consult with experienced real estate professionals.
Yeah.
Like brokers, appraisers, investment advisors.
People who know the market.
Exactly. They have that deep market knowledge
Yeah.
and can provide insights into those appropriate cap rates.
So you're kind of combining like
Exactly.
that data analysis
With what the experts are saying.
with expert opinions.
Yeah. Okay.
To make sure you have a well-informed cap rate estimate.
Okay, so it sounds like cap rate is super valuable,
It is.
but it's not like the only thing.
It's just one piece of the puzzle.
Yeah.
You have to consider all the relevant factors and do your due diligence
Yeah.
before making any decisions.
There's no magic number.
No magic formula,
Okay.
one-size-fits-all approach.
So I should really think about it.
Think it through.
Yeah.
Use it strategically.
Within the specific context.
That makes a lot of sense.
Yeah, it's about applying it thoughtfully.
Okay, so let's get into some real-world examples.
Okay. Love it.
Let's say an investor is considering two different properties.
All right.
Property A is like a newly constructed Class A office building
Nice.
in a prime downtown location.
Sounds good.
And that one has a 5% cap rate.
Okay.
Property B is a 20-year-old Class B office building
Right.
in a suburban area,
Okay.
and that one has an 8% cap rate.
So two very different properties.
Yeah. So what are some of the things that we should be thinking about
Yeah, what are some of the key considerations?
when comparing these two?
Well, the first thing that jumps out at me is obviously the difference in cap rates.
yeah.
Right? Property B has a higher cap rate,
Ah,
which, on the surface might seem more attractive.
yeah.
But as we've been discussing throughout this whole deep dive,
Yeah.
cap rate alone doesn't tell the whole story.
Right. You got to look at all those other factors.
You got to dig deeper
Yeah.
and consider the context of each property.
Okay, so like with property A,
Yeah.
even though it has a lower cap rate,
Uh-huh.
it is in a prime downtown location.
Which is a huge plus.
Yeah, so that probably means you're going to have higher rental rates.
Most likely, yeah.
And it's also like a brand new building.
It is.
So you're not going to have to do as much maintenance
Probably not, right?
or worry about like, big expenses.
That's capital expenditures
But yeah.
in your future.
That makes it more attractive.
Those are definitely factors to consider when
Yeah.
you're evaluating the long-term profitability of an investment.
Yeah. With property B, even though it has that higher cap rate,
Uh-huh.
it's 20 years old
It is.
and it's in the suburbs.
What kind of challenges do you think that might present?
Well, I imagine with an older building, you're going to have more maintenance.
You're probably going to have more maintenance.
Yeah.
Yeah. Potentially more upgrades.
And depending on like what's going on in the suburbs, it might be harder to find tenants.
That's right. You might have higher vacancy rates,
Yeah.
lower rental income.
So even though it has a higher cap rate, it's not as simple as that.
No, it's not.
Okay.
It's riskier.
Yeah.
Yeah. It carries more risk and more uncertainty.
So it really is about like weighing those trade-offs.
It is. It's about finding that balance
Yeah.
between risk and reward.
Okay, cool.
And in this case, that lower cap rate of property A
Uh-huh.
might be justified
Yeah.
by its prime location, newer construction,
Yeah.
and those potentially more stable income streams.
So low isn't always worse.
Lower is not always worse.
Okay.
It's all about context.
Yeah.
It's about understanding the nuances
Okay.
and using cap rate as a tool to help you make informed decisions.
This is great. I'm really starting to understand all of this.
I'm glad to hear that.
This is a lot more nuanced than I think I originally realized.
It is. There's a lot to it.
Yeah.
But it's a valuable tool
Yeah.
for real estate investors to understand.
Yeah. Definitely. Okay, so I think in the next part, we're going to continue this conversation.
We're going to talk about different property types
Yes.
and how those affect cap rates.
I'm excited to get into that.
Yeah. Should be good.
It sounds like cap rate is a really valuable tool, but it's definitely not like a one-size-fits-all solution.
No, not at all.
It's more about using it to
Yeah.
understand the nuances of each deal.
It is. It's about seeing the bigger picture.
Okay.
So I want to shift gears a little bit and talk about different property types,
Okay.
because the article mentions that cap rates can vary
Yeah.
significantly
Yeah.
depending on the type of property you're looking at.
Yeah, I've noticed that properties with like stable long-term leases, like maybe like a triple net lease retail property or an industrial warehouse,
Yeah.
those seem to have lower cap rates
Right.
than something like an apartment building or a hotel.
Yes, that's right.
Why is that?
So it all comes down to risk and predictability. Those properties with long-term leases tend to offer more predictable income streams.
Okay.
They're seen as safer bets,
Okay.
which makes investors more willing to accept a lower rate of return.
So it's kind of like what we were talking about before with those blue chip stocks.
Exactly.
Yeah.
It's that stability and consistency that investors are drawn to.
Okay.
On the other hand, properties like apartments or hotels where leases are shorter term,
Uh-huh.
vacancy rates can fluctuate more.
Yeah.
Those are perceived as riskier.
Okay.
So investors demand a higher cap rate to compensate for that added uncertainty.
Makes sense.
Yeah.
And I imagine that even within the same property type, location plays a huge role.
Location is always key.
Yeah.
So, for example, a retail property in a bustling downtown area
Yeah.
would likely have a lower cap rate than a similar property in a struggling suburban strip mall.
Okay. That makes sense.
Yeah.
It really is about understanding the market
Absolutely.
and what's going on.
Yeah. You have to know the dynamics of each market and how they influence cap rates.
Okay, so we've covered a lot of ground here.
We have. We've done a deep dive.
I feel like I have a much better grasp on this concept of cap rate
Good. I'm glad to hear that.
and how investors can use it.
Excellent.
Yeah.
It's a journey, though.
Yeah.
You know, there's always more to learn,
Yeah.
new strategies to explore.
Before we wrap up, I do want to circle back to reversionary cap rate
Okay.
because I'm still kind of
Yeah, it can be a little tricky.
trying to figure out like how to use that effectively.
Yeah, so remember, reversionary cap rates are all about assessing the potential upside
Okay.
of properties that aren't fully performing.
Okay.
You're factoring in the potential for future income growth and appreciation.
So give me like another example of how that would work.
Sure. So let's say we're looking at a multifamily property
Okay.
with below market rents.
Okay.
The current cap rate might be high because the rental income is low.
Yeah.
But if you believe you can renovate those units, increase the rents to market rates, the property's value could increase significantly.
Okay.
Yeah.
So the reversionary cap rate is what's helping me like,
It helps you estimate
estimate what that future value could be.
that potential future value
Yeah.
based on that projected income increase.
But like we were saying before, it's important to be realistic.
Absolutely. It's not a guarantee.
Yeah.
You know things happen.
Yeah.
You know markets change.
You never know.
Unexpected expenses come up. You have to be prepared for that.
So you have to balance that optimism with
Yes.
a little bit of realism.
A healthy dose of realism and, do your due diligence.
This has been such a great conversation.
It has.
I've enjoyed it.
I've learned a lot.
Good. I'm glad.
And I think our listeners will too.
Yeah, I hope so.
So just to kind of like wrap up this whole deep dive
Yes.
on cap rate,
Uh-huh.
the main thing is that it's really valuable
It is.
for understanding a property's income generating potential. Absolutely.
But you have to use it with a lot of other information.
Yes. Context is key.
I got to look at the specific property, the market conditions.
Your own investment goals,
Yeah.
your risk tolerance, all of that.
Yeah.
It all comes into play.
I couldn't have said it better myself.
Well, there you go.
So, to all of our listeners out there,
Yes.
keep exploring, keep learning, and remember, real estate investing is a marathon, not a sprint.
That's right. You got it.